Most people think that the stock market is ridiculously overvalued right now.
80% of CFOs say the stock market is overvalued.
The United States stock market is very overvalued.
Is that really true?
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
In this video, we're going to talk about why everyone seems to think the stock market is in a bubble. We'll look at the current versus the average PE ratio, which is what most people would cite. We'll also look at the Shiller PE ratio compared to the long-term historical average. Then I'm going to show you what the missing piece is for the majority of valuation videos and commentary that you'll see. We're going to combine the fundamentals and this missing piece into a data-driven S&P 500 model that uses data from 1960 to 2021. Then I'm going to show you the output of that model, which estimates what the fair value of the S&P 500 is today. Before we get into that model, this is what pretty much every market commentary says right now when it comes to valuations. This is a piece from Advisor Perspectives. It says, based on the latest S&P 500 monthly data, the market is overvalued somewhere in the range of 121%, and they cite 4 different models that suggest the market is significantly overpriced. One of them is here, the cyclical PE10 or the Shiller PE ratio. And then the other is this PE ratio compared with the long-term average. So we're going to look at both of those in more detail. Here is what you'll see on pretty much any valuation article or commentary. You're going to hear someone say that the current PE of the S&P 500 is just under 46 times. The long-term average is 16. So stocks are way higher PEs today than they have been in history. So that means that stocks are way overpriced. In fact, if you just simply calculate the ratio here, you arrive at a 187% overvaluation for the stock market just based on the current PE compared to the average PE. So that means that stocks are in a bubble, right? Well, there are 2 major problems with this analysis. The first is that PEs oftentimes use the trailing 12-month earnings per share. That is fine in most environments. However, it can get really far off in periods of recession. So this is the inflation-adjusted PE ratio from 1875 to 2021. And you can see that the highest reading was right here, 123 times earnings. And this happened in 2009, right before the S&P 500 went on to produce over 200% returns, starting the longest bull market ever. This PE ratio said that stocks are more overvalued than they've ever been before. The problem was not that the price was high. Actually, the price was at multi-decade lows. The problem was that the denominator, the E part of the equation, was artificially lowered by the recession. So here is the E in the PE ratio. This is the S&P 500 inflation adjusted earnings going back to 1875. So here you see in 2009, the earnings absolutely collapsed because of the great financial crisis. So if the price remains constant, but the earnings per share decline by 50%, that will make the price to earnings ratio increase by 50%. So it looks like the market is overvalued when in reality, the earnings are just temporarily depressed. So when the earnings rebounded like they did in 2010 and beyond, the price to earnings ratio will normalize. So how do we correct for this short-term issue with low earnings affecting PE ratios? We can do it by simply averaging out a longer time period. So Benjamin Graham, back in his book, Security Analysis, he suggested that before you buy a stock, you look at the 7 to 10 year average of that company's earnings to determine how that company really is making money throughout the entire business cycle. So Robert Shiller took that concept and did a 10-year average of the S&P 500 earnings, and it now is known as the Shiller PE or CAPE ratio, as you might have seen it, which basically just takes the inflation-adjusted earnings per share and averages out over the last 10 years. So this green line is the 1-year trailing earnings per share. The purple line is the 10-year averaged earnings per share. And you can see that this line is a lot more smooth, and it rarely does these substantial collapses like we see with the 1-year number. So specifically here in 2009, the earnings did decline a little bit. The Shiller average, 10-year average earnings declined a little bit, but not nearly as much as the trailing 1-year earnings, which means that when the price declines like it did in 2008 and 9, the earnings do not decline with it. So you get a situation where stocks appear to be quite cheap in 2009, which is correct. And in other time periods when the earnings have been maybe artificially too high for the last 12 months, you get an opposite effect. So stocks look more expensive, correctly more expensive than they otherwise would. In my opinion, this is a much more realistic way to look at earnings per share. So if you're going to look at any PE ratio, probably the single best PE to look at is the Shiller PE or the CAPE PE ratio. That currently is 38.3, which is 122% higher than the long-term average around 17. So again, we see that stocks are substantially overvalued, even using this better price to earnings ratio. However, that's not the full story. There's one more piece that is missing from all of this valuation discussion, and that is interest rates. This is a chart showing the Shiller PE ratio in blue. So this is what we just saw was at about 38. And we're going to compare that to the red line, which is the 10-year US Treasury bond yield. And you can see that there is not a perfect, but a pretty good negative or inverse correlation between these two. So as interest rates go up, we generally see the Shiller PE ratio go down, and when interest rates go down, we generally see the Shiller PE ratio go up. So here in this, you can't really see what this is, but this is basically in the late 80s, the late 70s, when interest rates went up to 15% on the 10-year Treasury. That's when the CAPE PE ratio actually dropped below 7. So high rates equals low price to earnings ratios. And then in recent years, we can see that rates have gone down substantially from 15 to now around 1.5%. And the PE ratio has increased at almost the exact same rate. So we can combine these two data points into a model. And that's what I've done. I took over 2,000 monthly data points from 1960 to 2021. So those data points were the S&P 500 price in today's dollars. To predict it, we're using the 10-year US Treasury yield and the 10-year average earnings. Again, that's also in today's dollars. So we're adjusting all of this for inflation. And what question we're trying to answer is, what is the fair PE ratio, the fair price for the S&P 500 today, adjusted for the current interest rate environment? That's important. So for you stats geeks, if any of you are stats geeks, these are the stats. Basically, this model is highly statistically significant. They're the p-values, and the r-squared is just under 83%. So in other words, this model predicts about 83% of the long-term movement in the price of the S&P 500. So let's take a look at what that model says through time. This is a chart showing the S&P 500 price in green and the model's predicted price in orange. And then this gray error range is basically the noise of the model. So we would say that 68% of the time, we would expect the actual price of the S&P 500 to fall somewhere within this error range. 3 out of 10 years, we would expect it to get outside of that error range, kind of like what we saw here from the mid 1990s to the early 2000s. And then you've got a little bit of that here back in the 70s, and then a little bit here in 2009 when the model got, the market got way below expected value. So anyways, what does this model say today? Right now, if rates stay at the current levels, which according to this model, I had them at 1.29%, which was the 10-year treasury at the time of this video, the current value of the S&P 500 would be about 3,700. That would be 14% overvalued, not 121% or 187% or 270 something percent. And then the range of what the S&P is likely to be at, or would be normal to be at in this interest rate environment, is somewhere between a low of 2812 and a high around 4900. So in other words, if interest rates were to stay at 1.3% based upon the historical relationship between price and these fundamental variables, it would be normal for the market to trade somewhere between these two values. And this also assumes that the Shiller P earnings per share is $114. If that were to increase or decrease materially, that would also impact this model. Another thing that really drives this, again, like we've talked about, is interest rates. I ran another forecast where I changed the interest rate from 1.29 up to 2.29, so basically a 1% increase in rates. If we did that, the value of the S&P today would drop by about 10%, or the predicted value would drop by about 10%, down to around 3,350, and the new range for the market should be somewhere between 2,500 and 4,400. And again, these are the assumptions that we're using for this particular input. So the bottom line is, at least according to this model, the stocks are slightly overpriced, but within a normal range. They're certainly not in a bubble like a lot of people would suggest. That does rely on interest rates remaining at 1.3%. If they stay low, there's no reason why stocks can't or shouldn't stay at extremely elevated price to earnings ratios, at least compared with history. In fact, PEs could expand even further based upon this model. The biggest issue is really for valuations would be a spike in rates. So a 1% increase in the 10-year, according to this model, would suggest about a 10% decrease in the price to earnings ratio for stocks. And that's assuming all else being equal with earnings, etc. So again, this is just a model. We're taking the historical data, plugging it into the statistical software, and it's giving us an output. That doesn't necessarily mean this is perfectly accurate. It's not perfectly accurate. It's just an estimate based on the data that we have. But using the data we've got, unless you think interest rates are just going to increase substantially from here, or you think earnings are just going to absolutely collapse from here, stocks appear to be, certainly not cheap, but they're in a reasonable valuation range based on where rates are at. So